First rates, 27 points higher on the Nifty. The market breadth 1:13. That's really been the hallmark. But there is no elevation which so far has kicked in the bank Nifty. That's why you want to see a little bit of opening up, some flexing of muscles by HDFC and ICICI Bank. So the bank Nifty is off to a flat start, nothing meaningful in the Nifty. It's like saying that yesterday was a good Thursday and the fall up at least in Friday morning, I think is clearly missing. Then you want to look at railway stocks and you want to look at shipping stocks or defense stocks, and then you want to look at power stocks. Railway stocks, RVNL, 156 rupees, IRFC, 5% higher. IRCTC really has not been the plum pick, so to speak. It has underperformed because variety of factors will mark that stock. Now the real heroes yesterday, Cochin Shipyard and Mazgaon Shipyard. Cochin Shipyard yesterday I think was up 20%, it's up another 7%, there you go. And then you got to look at Mazgaon Shipyard, that again is up by another 6%. And this is what is the amazing part about this market, that the rally, that linear move, the uptrend in some of the defense, railways and some of the aviation stocks, it just is mesmerizing to say the least.
I was just noticing that most of them are almost four-digit names, right? Mazgaon Dock, you've got an HAL as well, Garden Reach almost getting there to a four-digit figure. Look at the tear that you're seeing on Mazgaon Dock. It's up 7.5% as we speak right now. Garden Reach as well. So the shipbuilding names are the ones which are really taking the fore after what's been a very, very strong and buoyant bout for both defense as well as railways. Not to say that those spaces are not looking good, but the big spurt is now coming in the shipbuilding names. What else is moving higher? Let's just take stock of all the stocks that are in focus this morning. And Landmark Cars, they've added M&M vehicles to their offerings, so let's check out with that. Of course, for Mazgaon, I must mention that they've signed a master ship repair agreement with the US government, which is why that near-term trigger and the stock holding up by 7%. There's Eris Life as well, which says they're going to continue to grow 400 to 500 basis points faster than the IPM, so that stock mildly higher as we speak right now. Page Industries, the big mover from yesterday, and they've set an FY26 target of about 80,000 crore rupees in terms of revenue. That's the note and the takeaways coming in from Novama, but not really seeing any follow through on Page. Max Healthcare, Macquarie maintains their underperform rating, saying they're maxed out for now. Target price at 465. That stock is lower by about 1%. But I don't think, the market is really about the newsmakers today. It's really about momentum, and the pockets that are seeing momentum continue to be some of the select large caps like HDFC Bank and L&T, and of course, what you're seeing within the underlying trend of the entire larger infra picture. Look at L&T, that's holding at 2,900 plus levels now. It's another 2.25% move after that big spurt that you had on L&T yesterday. And for a large cap heavyweight to move with this kind of a quantum on a daily basis is quite remarkable. I just want to revisit what HDFC Bank as well is up to, and whether that's also joining hands with L&T as one amongst the top gainers. Not as much today, it's a lot more tempered. But yeah, railways, shipbuilding, Kunal, what are the first trades you're punching in?
Well, yeah, looks attractive. Again, as a setup with large cap stocks doing pretty well from where they left off yesterday. HDFC Bank is something which I would pick as the opening trade. Looks very attractive as a charts, specifically in terms of the futures. We've seen a good combo over the last 3 days. The stock showing signs of pickup of price action, breaking past above the previous high. So looks very attractive for an opening trade.
Right, Shivangi, what are the first trades that you're looking to punch?
So the first trade, I'm looking at Maruti. The stock has, really performed, and after a long consolidation, it is coming out. And the good part is that it retested some of its recent swing highs, and now it's again made a good base to move, higher. So recommending a buy here with the next 10,720 odd levels and a stop near 10,180.
Shivangi, appreciate your time and thank you for joining us. Railway stocks is where the uptrend I think continues. Defense is where the excitement is, and the market meanwhile are gaining some weight. I think that's evident looking at the way how things are moving. Manish Chaudhary joins us. Let's understand from him that what he makes of the global construct and why the India outperformance is real. Manishi, good morning. Thank you for joining us. Manishi, there is a bit of a global scare in the world, but that is not having an impact on Indian markets per se. FIs are selling, but DIs are buying. So do you think we are in for more of the same for next couple of quarters now, next couple of months?
Well, it's been a story of India for quite some time now. Think of the period October 2022 to somewhere around, I think October 21 to June 22, rather. There was almost, I think, about anywhere between 23 to $27 billion of FII selling during that period. What did the market do? Hardly anything. It was, I think, down about 5% or so. If you go back about 5 to 10 years, that quantum of selling would have made a serious dent in the market. But this newfound enthusiasm on the part of the domestic investors, and this has been going on for the last 3 to 5 years, actually places India in some kind of a unique sweet spot among the emerging markets. There's almost no other emerging market where the domestic interest and domestic action in the equity markets has increased to this extent. And consequently, no other market where the domestic influence is more than neutralizing the fluctuations in FII interest. So I think, yes, going forward over the next quarter or so, we're going to face uncertainty about the monetary policy trajectory of the global central banks. And naturally, equity markets worldwide, and possibly more so in emerging markets, we would continue to see volatility. India would continue to remain relatively insulated. And one strong reason behind that is going to be this, the domestic investor enthusiasm that we're seeing right now.
Manishi, so curious to understand, considering India continues to be the preferred destination, where is it that you've added positions or, executed fresh buys in your recommendations?
In our Asian model portfolio, we have been overweight on India for about 3 months now. We were, kind of neutralish in the first half of this year, but in late June, we turned overweight. And the big weight in the India silo are financials, number one. That's predominantly private banks. The second important silo are the consumer universe, a bit nuanced here. So we have significant weight in autos, consumer discretionaries. And we have recently added some bit in consumer staples. The relatively the low end as far as the valuations are concerned. We are a bit cautious about valuations in the consumer staples segment. And apart from that, we have significant weight in TMT, tech, media, and telecom, both IT services and telecommunications. And when we talk about telecommunications, we are referring both to pure plays and conglomerates. So, if one compares to the benchmark weight, our overweight stance on India is possibly the most pronounced. We do have overweights on Hong Kong, China, and Korea also, but they're relatively lower in comparison to the benchmark weights of those markets.
India remains one of the top weights, and financials, of course, is driving that confidence. But Manishi, what's the sector which is a very clear underweight right now, one that you should completely stay away from?
We are not too positive on metals, mining, materials. As long as China, economic growth in China continues to disappoint, and the real commodity demand boosting sectors like property continue to face turmoil over there, I think it would be prudent for investors to stay away from the commodities, particularly materials and mining. We are also, even though I talked about, adding consumer staples in a small way, for much of the very well penetrated large frontline consumer staples companies in India, we are a bit cautious about their growth trajectory going forward. Also, the kind of valuations that they are trading at. So those are the two sectors that readily come to mind, when we talk about staying cautious about certain segments in India.
Then if the recent material prices have gone higher, if US economy is coming back, I mean, nobody's working with the assumption that US demand could surprise us. Do you think the China concerns will be diluted?
As far as metals and mining are concerned, vast majority of consumption, close to 50 to 60% of most of these are consumed in China. So the only exception I can think of is energy, oil and gas, where the Western Hemisphere still remains in the driver's seat as far as proportion of consumption is concerned. But apart from that, when one talks about industrial metals, etc., I think China still remains in the driver's seat as far as demand goes. The only, tiny little exceptions that one can think of are the metals which go into the EV supply chain, the electric vehicle supply chain, because EV demand, after suffering for a few quarters, has again revived in China. So, those are some bits and pieces of minor exceptions that I would point out. But for much of the frontline industrial metals, I would possibly still stay away.
Just to know what you're making of the big move that one is seeing, across categories and especially defense-related themes. Pure play defense manufacturers, shipbuilding, even railway stocks. The infra theme has really come to the fore, and it's these newer sectors which are finding value amongst investors.
In fact, that's a very interesting point you make. And my apologies, I did not mention one of the core sectors that we are focused on in India. In fact, industrials is a sector that we added sometime in June to our Indian silo of the portfolio, and for exactly the reason that you pointed out. The government expenses on infrastructure, that has been going up steadily. If one looks at the proportion of government capex as a proportion of total government expenditure for the past 3 to 4 years, it has really skyrocketed. It used to be about 15 to 17%. It's gone up to 25% in the latest budget. Much of this is coming in railways, in shipping, in port and other inland transportation. So intra-city mass rapid transit. So these are the sectors, and of course defense. One can't forget that. So these are the sub-segments within within government capex that we're positive on, and we think that it would also have a rub-off effect on private sector capex. One can't forget the China plus one story here as well. We're seeing the initial nascent signs of that. So all in all, we do remain focused. We do remain positive on the capex story in India, and our inclusion of industrials is a reflection of that constructive attitude.
Industrials positivism is something which is quite visible, but Manishi, is this view valid for even the power stocks?
You see, in power stocks, we think one has to be a bit nuanced, because the focus of India, much like most of the emerging markets and the developed markets, is possibly going towards green transition. So that is where much of the incremental expenditure, much of the incremental policy initiatives would possibly be focused in. So we don't have any specific inclusion or specific stock that we have, but much of the frontline industrial companies are also engaged in that area, and it's a space that we would definitely be watching carefully.
Such a pleasure having you on the show today. Thank you so much for taking the time out.
Thank you. Thank you very much.
Okay, let's just revisit what the market is settled in at. While it was sure a quiet start for the index, but guess what? We've made it to 19,800 on the Nifty futures. Talk about to 20,000 being in sight, and it's L&T once again, hands down. Almost a 3% bump up is what you're seeing on the stock, and that's scaled up very, very smartly. It's leading on the front within the large caps and the Nifty. Bajaj Finance is doing very well. There's Maruti as well, which is holding out well. M&M is looking good. And then, of course, there's Bharti and NTPC as well, which are making a decent move. From within the liquid universe, there's also Shriram Finance, Idea, Petronet LNG once again after that big breakout move on the stock day before. Havells as well is holding up 1.6% as we speak. But here's as promised, the exclusive chat with with us. Indian Hotels MD and CEO Puneet Chhatwal talks about the growth opportunities that have opened up because of events like B20, G20 and of course the upcoming World Cup.
The theme of India's G20 presidency is Vasudhaiva Kutumbakam, one earth, one family, one future. And the global power center in the world later this week will shift to India, as India will be hosting G20 summit. And as always, the Taj group of hotels have extended the iconic hospitality. Taj has partnered with G20 to welcome the guest and really endorse the spirit of Atiti Devo Bhava. So excitement, hard work, lot of preparations and an excellent welcome is what you should expect when it comes to the dignitaries who are visiting India. But what about the preparedness and the hard work and what we should expect in terms of the iconic hospitality? हिंदी में हम जिसे बोलते हैं मेहमान नवाजी. इस साल हमें मेहमान नवाजी क्या एक्सपेक्ट करनी चाहिए ताज ग्रुप ऑफ होटल से? Let's take that conversation forward with none other than the CEO of the Indian Hotels, Mr. Puneet Chhatwal. What is good for the sector is always great for shareholders. Should the shareholders of Indian Hotels be mighty excited that G20 means hotel rooms are sold out at rates never before, occupancy levels are high, and that is something which will be reflecting in this quarter?
It is that all hotels are sold out on these dates, but I think we have to look beyond a few days. I think as I mentioned earlier, Nikunj, the lasting impact of the G20 and the B20 that happened recently is far higher than just a few days of completely sold out rooms. Of course, it helps because that makes like September a very extraordinary month. So that definitely is a positive tailwind for all of us. And the good thing is that the events are happening in Delhi. The good thing is we are very well prepared for it. The good thing is the security levels are high. The good thing is all the chefs are planning and cooking and creating the best of their magic. And so is all the other associates, whether it's comes to your butler service, to service on the floors or other parts of the hotel. I think all that should give an additional boost in the next few days, and we are very pleased with that.
Mr. Chhatwal, we are talking to you after a while. So just to shift gears from what this quarter is looking like versus what the next quarter could be looking like. You've always been very open about sharing your order booking, your outlook for next 2 or 3 quarters. So once the G20 sugar rush is over, what happens next then? Because the next quarter, which is Q3, which will in a sense will be the most important quarter for you.
Q3, as you rightly say, has always been the most important quarter for the sector. And Q3 results are absolutely critical and important in their contribution to the full financial year. Now, having said that, Q3 is also blessed with Diwali. Q3 is also blessed with Christmas, New Year. And this year in particular, we also have the World Cup cricket happening as an example. But if we take a step back and don't look at only these one-off events, what we are witnessing in the last 16, 18 months is that demand is outpacing supply. Supply is going to remain constrained. So if the demand continues to outpace supply, the occupancy levels will be higher and the that would mean that your ability to charge, which means the average rates, will keep increasing. Obviously, we are also coming from a very low base when compared internationally. So the first major factor is the demand and supply balance. The second very important factor for the sector is, as I said, all this G20 is helping in indirect marketing of destination India. And that will encourage more and more people to come in. And we are expecting as of November or December of this year to get back to pre-COVID level of inbound tourism. We are nowhere close to that number if we adjust it for the arrivals which are only related to G20. The third important factor going forward for the buoyancy that we are having in the sector is that the majority of the pipeline of hotels that are expected to open are not in the top 10 key metros. As per a report done by Harvard Consulting, more than 50% of the pipeline is in tier 2, tier 3 cities. That means new destinations. So I think all in all these things, when put together, should help occupancies and rates. And if rates improve, the flow-through improves. And if the flow-through improves, obviously the profitability and cash flows improve.
So, Mr. Chatwal, if I connect the dots here, if I compare last year versus this year, there are two large events, G20 and Cricket World Cup, and the third cherry on the top really could be inbound tourism, where you expect normalization to happen and we could go to pre-COVID levels. So looks like next 2 quarters, if I put all these three factors together, there are good tailwinds.
I don't look at, as I said earlier, Nikunj, it's not just the quarters. The supply will not get built that quickly. So I think in the short and medium term, the demand will continue to outpace supply. And that is good for the hotel's ability to drive good occupancies and charge better rates. So it's not related to just 1 or 2 quarters. Because of COVID, because of lockdowns, very few of the hotels actually went under construction. Those that were under construction will obviously finish and will open up. But as I mentioned, the majority of that supply is not in Delhi, Bombay, Goa, Chennai, Hyderabad, Kolkata, the 10 major metros, or in the state of Rajasthan. So the supply in the top 10 markets is constrained. That helps you drive the performance, and newer markets are opening up, which is also good, especially the spiritual sector. The kind of boom that is happening in places like Banaras or in Ayodhya, the kind of spiritual tourism that is increasing in the way it is increasing. We are about to open our second hotel just in Tirupati. We have signed 2 in Ayodhya, and we are doubling the size of Taj Ganges in Banaras. So I think all in all, there is a lot of activity, a lot of buoyancy. Per capita income is growing. India is having good GDP growth, which means higher disposable income, and higher disposable income means more discretionary spend. And one of the beneficiaries of that spend is going to be hospitality and tourism.
But do you expect business travel, which again is a mainstay for a hotel chain like Indian Hotels, at least in metro, that also to remain robust? Because that's where you get real benefits of capacity.
Absolutely. And the spend that is happening from the government on the infrastructure development, whether it's the renaissance of train stations or new airports or investment in highways, and look at the convention center in Pragati Maidan or the one opening in Dwarka and the addition of Jio in Mumbai. All this is going to capture latent demand that was not there before. We did not have the capacity to host 1,000 people sit-down event in any place in India. So maybe there was one or the other, but to have that in the main metros, the country's capital, and in the financial capital of the country is very important. And I think that is going to drive new sources of demand and also new sources of business which we had not tapped in before.
Mr. Chatwal, one of the hallmarks of Indian hotels, and especially under tenure, has been margin expansion. Margins are now sustaining above 30%. And as more and more capacity will get added up, will 30% be the new normal for Indian hotels?
Under Avan 2025, the guidance that we have given is 33, and we feel that we will remain close to that, if not overachieve it. So the likelihood, last year we ended up almost at 33. So we remain very optimistic because of the change in the business model. So we are guided on a strategy which is built on a healthy mix of asset heavy and asset light. So majority of our hotels that we are opening as of this month will be opening now 2 hotels per month going forward over the next 3 years, which means 24 hotels in the next 12 months and 48 in the next 24 months. So and almost all of that is not owned. It's some of the Ginger would be coming under an operating lease, and the rest is all management contract, except for the flagship Ginger, which you're opening in the next 6 weeks in Mumbai, in Santa Cruz. So given all that, the margin expansion is a consequence of that kind of contracts that we are doing. So we do enjoy at the moment a very good operating leverage that we get from the owned portfolio and the margin expansion through management contracts and through new businesses that we have ventured into.
Just a couple of follow-up questions, Mr. Chatwal. I mean, it's such a pleasure to have you on ET now. So I'm taking the liberty of extending my appointment with you. When do you think some of your new ventures, the reboot of Chambers, Ama, Cumin, when will they start having a needle-moving impact on your profitability where you will start accounting them as verticals?
Well, Chambers is already there, and Cumin is getting there, as Cumin, which started as home delivery, is evolving into also a QSR. So all our Ginger hotels, all-day dining restaurants will be called Cumin. 20 of them have already got done from a portfolio of 60 in operation. So slowly we are transitioning, and I think over the next few years, we should have at least 75 Cumin branded restaurants. On Chambers, as you know, that we are opening the new Chambers in West End. As we speak, the renovation of the Chambers in Land's End in Mumbai is getting finished, and then we will also start with the renovation in Colaba.
Back with the market, right here on ET now. Let's now discuss that very hot sector in the market, and that's been power, right? Everything from what's happening with the power demand, whether or not, India has the bandwidth to actually meet with the surge in power demand or not. A lot of these questions really perturbing all of us because from an investor's perspective, not just that the power demand is at an all-time high, but some of these stock prices as well have spurt quite a fair bit. And it's interesting, Nikunj, when you think of power, you think of only power producers, but there is a whole machinery around it. It's not just one segment of stocks.
See, fundamentally, you must realize that what has happened. The power demand, the gap between supply and demand, I think is surged. Variety of factors. A delayed monsoon, more demand which is coming back as the penetration level of air conditioning is increasing, industrial capex has started, and no large capacity expansion has happened in the thermal area because companies were very conscious of not expanding in the ESG space. Wind power has not taken up, and it is sad that if you look at the solar capacity addition in India, that's been good, but it's been not really what you anticipated or expected, let's say 5 years ago. Time and again, we've seen that how seasonality has also played a very large role in terms of how the power demand is surging. But what experts who track the sector are telling us that for next 2 or 3 years, we could be in for a situation, I will not use the word precarious, but I would say it is something which we need to flag off, where demand will outstrip supply, because supply takes time to kick in. It takes time to kick in terms of when the capacity will be added, how the capacity will be added, and before the capacity and the fine print is actually signed with the discoms here. But an important aspect of Indian energy need is coal, because in India, large part of the power plants are still thermal based. And time and again, we've seen that every time when the demand surge goes higher, you get worried about the coal levels in India. So what is the solution? What is the realistic picture? Should there be an easing off in terms of coal imports, or that is something which may not be a permanent solution? It's more like a band-aid approach. Let's take that point forward with Partha Bhattacharya, former chairman and managing director of Coal India. Partha, good morning. Thank you for joining us. I'm going to start with a very basic, question. Do you think India has enough and more coal availability to meet the surge in power demand? Because India is still dependent on coal produced by Coal India to fire their thermal plants.
Well, you see, the availability of coal in India is not in doubt. There is abundant availability. The issue is one of policy. See, you can't have a situation where coal comes to the rescue of the power sector if you are doing on and off kind of situation with coal. Today you say that no more coal power plants are required. Tomorrow you say no, another 30,000 megawatts of power plant has to be developed on coal. So you open up coal, again you take a different kind of an approach, you go more for renewables. Renewables are absolutely fine, but you have to have a consistent policy. I think that is where we have a problem. If you just give me a 1 minute's time, I'll just try to explain this. You see, starting from 2017-18, we saw a situation for successive 3-4 years where every year coal production was degrowing and stocks were increasing. Reason was that we all felt that coal is the epitaph has to be written on the coal sector. There is no need of coal. And now again in 21, when the post-COVID economic recovery started, suddenly we found that we are in a precarious situation. Coal has to go up. Fortunately, we had at that point in time 100 million tons of coal in stock, so we could draw upon that stock. That stock was with Coal India. So there was a stock drawdown from 100 to 60 million. 40 million ton drawdown took place. And that's how the power sector could be, their requirement could be met. 22-23, we did something more constructive. We actually increased production by 80 million tons in Coal India, and also the captive miners. That segment also started producing more coal. So, and now again, sometimes if you say that no more coal power plant, coal is on the way out, and these kind of things, then it doesn't send right messages, right signals across the situation. We have to be very clear that we need coal for the next 25-30 years. And there is no denial to that. Renewables should be allowed that kind of time to come up to a particular situation. India is a situation where the per capita power consumption is one of the lowest in the world, 1/3 of the world average and 1/5 of China. So it has to grow. If India develops, that has to grow. And if that has to grow, you can't meet it with growing renewables. You have to have renewable can only complement coal. That is the Indian situation. Worldwide, if you are adding renewable capacity, fossil fuel-based capacity should decrease. But it is not the situation in India. It's basically a complementary kind of situation. And earlier we realized that this situation is going to continue for another 25-30 years, the better it is. Then we should be more, in a more holistic manner, we'll be able to address the needs of energy security of this country. This is my take. And of course, we have sufficient amount of coal, particularly thermal coal, there is no problem. And lots of coal blocks have been auctioned. Those blocks should also come up. There are some constraints there, financing constraints and all those. If those constraints can be addressed, and the financial policy of the banks, etc., are more attuned towards the Indian requirement rather than the global kind of ESG things, I think in that situation, we should not face a situation where the country goes into a power shortage, very critical power shortage. We should be able to avoid that. But we need holistic policy considerations. Well, climate change is important. We have to address all those things. But at the same time, we have to meet the growing energy demand of a growing nation. That is also paramount. So the two things don't meet really. We have to really look at it in a more holistic manner so that the both objectives are achieved, and there's a progressive phase out of coal maybe after 20 years. For the current situation, coal consumption every year will be higher than the previous year. That we cannot avoid that situation.
Obviously. But Mr. Bhattacharya, just wanted to understand, in the very near term, do you think the situation with coal availability could get worse before seasonality, seasonally weak winter kicks in? And will we then have to increasingly resort to, say, imported coal to meet our needs?
See, I will tell you, from the second half of 21, I mean FY22, rather 21-22, the kind of growth in coal production that the country has witnessed has never happened before. I mean, we are growing at more than 10%, in double digit. I have not come across a situation where Coal India had that kind of growth. So if that kind of growth happens, I don't see a situation where coal should be, I mean, there should not be too much of dependence on import. Yes, we have to depend on imported coal, not for thermal, for the other things like metallurgical coal and some high value, high energy thermal coal, which we don't have in this country. But for power, I don't see any. And of course, for the coastal power-based power stations which were designed on imported coal, leaving that apart, for the mainstream power plants, I don't see a need that the domestic coal availability will have to be supplemented or complemented by imported coal. I mean, there are more players have already come in. The Coal India is producing at a record high. This year, I'm quite sure they will again achieve another 80 million tons of growth, which they achieved last year. And the captive miners are also producing fairly well. The problem a little bit is with the coal block allottees. The new block allottees, they are finding it difficult to get finance and all that. So a little bit of policy intervention there may help them to come on board. If that happens, thermal coal should not be a problem for the next whatever years, even in the short term and long term both.
So if Coal India has to, in a sense, ensure that the coal availability is taken care of, do you think they are investing enough? Every time, sometimes the Coal India will blame it on railways in terms of rack availability. Railways will blame it on Coal India in terms of supply. Sometimes they both blame each other, and sometimes everybody blames them.
You have to appreciate that is more a matter of past. These days they don't blame each other. They are working in a very congenial and complementary manner. I mean, railways are also increasing their rake availability. Coal India is, of course, investing. It is investing as well as it is giving off a number of large projects on an MDO route. So that has effect of fast increasing coal production. I mean, you can imagine 13% growth in coal production in 1 year is unheard of. I mean, at least in our times, it used to be 5-6%. So Coal India has definitely geared itself in every sense of the term, and the railways have also matched their capacities. So there is no more. You'll not find in the public domain too much of hard-hitting sentences going across from here to there. They are working in a more with a sense of camaraderie. They're trying to solve a national problem.
My final question is in terms of the whole idea of imported coal. Do you think that is something which needs to be considered? It may be a band-aid approach, but a band-aid approach is necessity sometimes when it is an emergency.
See, we have been importing thermal coal also for quite some time. We have been meeting our demand-supply gap with thermal coal. But when after this Ukraine war set up and the coal prices became highly volatile, thermal coal prices, I think we learned a hard lesson that we should not depend, because thermal coal resources are hugely available in this country. For thermal coal, we should reduce or rather eliminate our dependence on imported coal to the extent possible. That should be our outcome. The coal that we don't have, metallurgical coal or very high energy coal, those things imports will continue. But thermal coal import, to my mind, should not be necessary. We should be able to meet that demand domestically.
Partha, great to have you on the show today. Thank you so much for taking the time out and joining in. In fact, we're going to stick it out with power as a subject. We're going to be joined by Harry Dhol as well in just a bit. We'll have a voice coming in from ICRA too. And we're also going to be talking to Worry Renewables to try and understand where the entire space is headed and cover all aspects of that. But after this very quick break.
Okay, 45 points higher for the Nifty, Meanwhile, the market in terms of the Sensex and the tone and the tonality, I think is just not going anywhere. There is no large elevation because banks are not chipping in, and that I think really seems to be the pain point for the market, that till the time banks will not chip in, they will not really have this push factor. If the engine sector does not move in, you cannot really convincingly say that, okay, we're out of the woods. Power is where the action is, and we'll take this conversation forward for next couple of minutes. We would be discussing this entire sector thread and bear on ET now. Hey Dewal, Director General of Independent Power Producers of India. He joins us now to take our conversation forward to understand that why there is a surge in demand, how long the surge in demand will continue, and who will benefit because of this. So Harry, to put it very simply, next 2 or 3 years, the supply and demand gap will only worsen. What will be the consequences of that? Do you think power prices in India will grow exponentially? What we are paying today is going to be much, what we will pay out 2 years from now, a year from now will be much higher than what we are paying today?
Nikunj, is the question to me?
That's right, Harry. Good morning.
I can hardly hear you. There's a little bit of muffled sound. Can you repeat your question? Sorry for that.
My question is that looking at the demand supply, which is how things are stacked up in the power sector, it appears that demand is going to be outstripping the supply. So to put it very simply, do you think...
To answer you, but unfortunately your voice is coming muffled. And you can switch to the next speaker, maybe they can fix the sound.
Sabyasachi, would you like to react to my, would you like to jump in? Did you hear my question?
I was able to, yeah. So basically, we are expecting over the next 2 to 3 years a demand growth of, anywhere between 5 to 6%, depending upon the underlying. I mean, our median estimate is somewhere around 5 to 5.5%, but there could be upsides depending upon, how quickly, how the economy takes off. So we are looking at 5 to 6% demand growth, and at best, the capacity will be barely able to catch up. Although we are adding a lot of, renewable energy capacity, we must remember that most of the renewable energy capacities have relatively low PLF factors compared to thermal, and the total, thermal addition is quite modest. But at the same time, the thermal PLFs are also not fully optimal. So there will be a slight, worsening of the supply-demand position. But I don't think, apart from, occasional, points in time, let's say April, May, or September, there may be a very sharp, mismatches between supply-demand. Broadly, the supply-demand should remain favorable, but not, we are not really seeing too much of, power cuts or blackouts or anything like that.
Power prices go higher. Do you think somewhere, whatever the gap is, the gap in a sense could really change the way how power pricing in India would move at residential level and at industrial level?
So yes, I mean, there will be, from the generators perspective, definitely there will be short-term spikes. I mean, if you're looking at the cost of traded power, yes, definitely there will be spikes. And what it will translate to the end user, that is tariff for the end user, whether it's industrial or commercial or domestic. Yes, overall, we would expect, the tariffs to go up. There's already a gap between, what the DISCOMs are spending to supply power and what they are realizing by way of tariffs and subsidies. So there's already a gap there. And on top of that, we can expect, increases in coal prices as well. Basically, there has not been much of a revision by Coal India Limited of the APM coal that they're supplying to thermal power plants. So we can expect, an upward bias on that, as well as there'll be occasional, spikes in the power that they are buying from the market. So overall, yes, we can expect the tariffs to go up over the next couple of years.
Harry as well joins in back on the show. Harry, can you hear me clearly now?
Yes, I can. Thank you.
Okay, great. Harry, just wanted to understand what is it that you're making of this spike, firstly, that one is seeing in power demand? And does it seem like this is transient or structural in nature?
I'm very excited about this because it's about time the power sector got its recognition. People were not even thinking about it for a long time. But I'm very happy that this is happening, a lot of focus. I think it is very sustainable because as the economy grows, people have begun to realize that you can't do anything without power, whether it is industrial, agricultural, commercial, whatever. And leaving aside the politics of it, this is definitely going to grow, and it's going to grow for a long time to come, because our economy is moving at a very fast pace, and it can only move thanks to availability of power. I also think the government is doing some super ideas on bringing in new technologies and bringing in dynamic policies, which are going to encourage the power sector players on all sides to do much better and to do much, in terms of performance, to become much better providers. So I'm very excited about the power sector, the way it's going. And yes, over to you again. I mean, I'd be happy to clarify and take this forward the way you want.
The other aspect, Harry, is also, while sure demand is going up and escalating with no degree, but can we meet that demand? That's the big question, right?
No, that's a very interesting question. I wish you were a cyber bot, to tell us, because it's all dependent on whether demand is becoming a little more complex to predict. And I think meeting the demand is a constant challenge because of the weather. Look at the way the monsoons happened this year. The result is that in the middle of the monsoon, the electricity prices have gone up. And, there are so many variables that need to be taken care of. And I think a lot of good steps have been taken to make sure that power is available. For example, as a previous speaker talked about, increasing of coal production, availability of coal, etc., etc. But at the same time, you need to see that you have to bring in more and more of technology to be able to predict demand. And for that, you need to have steps which have just been taken, where a lot of the players will be able to do much better forecasting. And that is going to play a very important role in planning, in implementation, etc. So I think the new guys on the block in forecasting will definitely play an important role. And that will improve the efficiency. The other point which is important here is that the environment aspect has to also be taken into account. So it's a very interesting balance that needs to be struck. While you have the government encouraging environmental attributes, carbon trading and all that, but you also bring in transparency for the consumer. Right now, consumer didn't have too much of a choice, at least at the retail level, to buy power from wherever he wanted. But now it's beginning to happen. And my prediction is that the consumer today is going to be the generator tomorrow. And that's going to happen thanks to the smart meters. Another area which is really going to be going crazy on this, on the exponential gain. So you got transparency coming in. You got a situation where it will be like a consumer eBay. You can.
Harry, I'm just going to encourage Sabyasachi also to come in, because I just want to address a very larger audience here. Sabyasachi, really from a market standpoint, everybody now is in a sense convinced that power demand is real. And the mismatch, I think, is something which is not temporary. It may be sporadic, but it could be the trend for next 2 or 3 years. There is a big profit pool which now opens up for companies which have a large exposure to merchant power. How do you see the merchant power as a category moving? And for our viewers who are interested in investing in some of the stocks or companies which would benefit because of this power shortage, which companies or which theme ideas would you have to invest in when it comes to this entire power equation?
So I would not be commenting on stock specific or company specific company specific and what could be the impact on the share prices, etc. But definitely it's pretty much clear that over the next 2 to 3 years, overall the short-term tariffs will be on the higher side compared to what we have seen often in the past. I mean, they may not be very sharp peaks as, for example, we saw in calendar year 22 around April, May, but still nonetheless the overall average merchant power tariffs will be on the higher side. So entities, whether they are thermal based players or even some renewable energy players have some amount of merchant capacity, they will definitely make much better money from merchant sales than they have often done in the past, particularly in the late 2018 to 2021 period, where the merchant realizations had been quite subdued. definitely they can look forward to better merchant tariffs over the next 2 to 3 years.
Harry Sabyasachi, gentlemen, thank you very much. So from coal to the current setup in the power sector, now we move to the solution. Now, if there is shortage of power for next couple of years, which is what all the experts seem to be indicating, what can be done? You need to have an alternative. Thermal plant, well, it takes years for the thermal plant to kick in. 4 to 5 years is the normal cycle. But when it comes to alternate sources, renewable sources, solar, wind, that's where capacity addition does not take that kind of a cycle delay. That is something which I'm just trying to bring out, that I guess the problem of the solution is very simple, that we need to change gears in terms of how the alternate sources of energy would be needing. India's energy demand will grow higher. The current power setup is such that the demand is going to outstrip the supply. But can solar be the real easy go-to solution to really start mapping up that? And I'm going to take that conversation forward with Mr. Hitesh Doshi, Chairman and Managing Director of Waaree Group. This group is one of the foremost players in terms of solar panel exports. It's quite ironical that in India we are importing from China, but we are also exporting. But is solar or adaptation of solar as a technology the easy solution to bridge that gap? So Hitesh bhai, good morning. Thank you for joining us. Always a pleasure to have you on ET Now. Thank you for joining us. We were discussing the setup for the demand as well as supply in the Indian power sector. Do you think looking at alternates, especially solar, wind, that really could be the easy solution to start bridging that gap? Because the demand shortage to hai, sir. Can this be bridged by going the solar route?
I think this is the best solution. And first of all, thank you very much for inviting me and giving this time. If we look to the globally, what the power demand has increased and how it is getting solved. Today, over 1,000 megawatt solar panels are deployed every day. And the reason is very simple. The installation of the solar panel is very fast. I mean, if somebody wants to put on his home, he can do in 3 days, 5 days. Number two is the lowest cost of the power today is produced from the solar panel. So price-wise, what we are seeing, this can not only help to meet the growing demand, but the solar also helps to reduce the cost and also the time. So what you have been capturing from this morning, the power demand is growing, and what is the quick fix? We strongly believe, and globally everybody believes, the solar is the solution.
What is the cycle and the duration if somebody has to set up a large thermal plant versus a large solar capacity? Can you walk us through the maths here?
It's completely different. To give an idea, we put a solar or we put a thermal, we will need a land and a grid connection. So if I take out the land and grid connection out of the complete implementation cycle or execution cycle, in 90 days, you can do a 500 megawatt execution in this country today in solar. So if you have the land and grid in place, the 90 days is a 500 megawatt execution. And I believe this is going to increase in the near future. So that's a time gap.
You know, the other thing, Mr. Doshi, obviously that one wants to understand is what does it mean, this surge in demand for you at Waaree? Are you seeing a lot more EPC orders flowing in?
Yes, it's a demand as well as the awareness of the cost of the power, and apart from the ESG, green energy requirements, the overall demand for the solar is growing across the globe, and we believe that this is going to continue this growth.
I look at the solar sector in India, and if I look at what a company like Waaree is doing, you are in exports. So when it comes to exports, it clearly means that Indian industry or Indian companies are viable enough. Otherwise, they would have not got export orders. But India is also importing from China. ये तो कहानी समझ में नहीं आ रही. Export import दोनों हो रहा है.
It's very easy. The policies of the countries where it is allowing the Indian companies to export. But when it comes to the India's import, at this moment, we have the open policy to get the panels, solar panels from the outside of the India. And definitely the cost structure in our neighboring countries is much lower than what cost structure we have in India. So we believe in this year only, we expect over $4 billion of the panels will be imported in this country, where the export will be not as big as that. So export will be lower. So that is the first gap. Now, why the export is happening? Many countries have put various trade barriers to some of our neighboring countries. And because of that, the Indian companies has the opportunity. The second thing, that when you are buying the panel, you are buying energy for 25 years. So you need a panel which will work for 25 years. You need that kind of the quality, service, and most importantly, the trust on the supplier. So that is another thing why the export is happening. And I will say the third and most important thing for this country is when we are exporting the solar panels, it is an export of the capital goods. That shows us on the Indian manufacturers and Indian products. So export should be definitely continued. At the same time, we need to now stop the import when the country has enough capacity. For example, the Indian manufacturing capacity has reached to the 40 gigawatt now, where we expect the deployment in the country between 22 to 25 gigawatt on an optimistic side. So that gives a clear indication that the country has enough capacity. And now anyway, we have to stop this import. So import-export समझ में नहीं आ रहा है. I think in next 6 months, it will be very clear. The import should be stopped and export should grow much higher.
Mr. Toshi, the other thing is if the sector is so lucrative, there's bound to be competition. One of the roadblocks is what you already mentioned, that the government should, stop looking at imports because domestically we have enough capacity. But what are the other hurdles that you see within the business besides, I'm guessing, increasing competition?
The competition will be always there, and it has been always there in the past also. So more the demand, more the manufacturers. We have seen the number of manufacturers today in the country has gone almost 80 plus, and the import has increased in all the terms. The challenge is how fast we increase our deployment. For example, if we go on the rooftops or on the solar water pumps, or we go to the telecom towers, whatever the applications you are seeing, where there is a huge demand during the daytime. And the solar has this probability to give the lowest cost of the power during the daytime. So how we match both together and how we increase the deployment. And we are seeing the huge growth on the deployment, but there is an opportunity to increase the speed and increase the deployment in the country. So competition will get the business, of course, Wari will get the business. But the most important, the mismatch of the power demand and supply, as well as the cost, overall will be able to give the benefit to the people, customers, and the industry altogether.
Okay, so let's spend some time understanding on what's next for the Wari Group. I was looking at the declared numbers, what is available in the public domain. There seems to be a big explosive growth in profits, top line, and order booking. Have you hit an exponential curve where next 2 or 3 years the rate of growth both in order book and profitability would be there?
Fortunately, we have a good export order book. So definitely there is some assurance of the supply, we call invoicing and dispatches. And definitely when you have the large volume to be shipped, the profit numbers are going to increase year on year. And this we could demonstrate in the last few quarters. And I'm sure this will continue in the coming days.
2 to 5 years out, are you confident that you will be able to maintain the historical growth rate? I mean, the historical numbers in front of me, they are looking very impressive.
As a company, we are working on a entirely the energy transition. And we are working not only on the solar, we started working on the batteries, hydrogen, offering the other solutions also. So growth numbers are going to come all the coming decades. That's we are very much confident, and we'll be able to maintain these numbers also.
You are looking at backward expansion is what I understand. What is the status of the land? When will you expect the financial closure of this plant, of this project rather? And when will the financials kick in? I'm blending three questions into one. I'll repeat again for the benefit of our viewers. What is the status of the land for PLI? When is the financial closure expected? And when will this kick in the balance sheet?
Right. The land allotment is done now. So the land work is finished. In principle, we got the financial acceptance and final financial approval is awaited. Probably next 60 days we will have it. Let me a little bit explain you what we are going to do. We are manufacturing the solar panels, and the new solar cell production is going to start by end of this financial year. And the new factories under the PLI which we are coming up, there we are going to start with the ingot. So we'll buy the polysilicon at this moment. We'll convert that into the ingots. We'll make the wafers, and from wafers we'll make the cells and the module. So this entire new factory will cover the entire supply chain right from the ingot to the solar panels. So it's a 6 gigawatt scale project, and overall investment in this project will be more than 8,500 crores. This machines has been selected, and probably the next month all the equipment orders will be also placed. And as soon as the rainy season gets over, the construction on site will also start.
You've done 2 rounds of fundraising. Will you go ahead for 3 or will you go public before that?
Our idea is to go for the public by the next year. This is a very dynamic industry. The opportunities are huge. We are also expanding outside the country in the manufacturing, and probably it will be finalized in the next couple of weeks. Some large gigawatt factories we are planning outside the country. So really speaking, this is a dynamic and fast-growing industry. The plan is going for the IPO, but if there is any other opportunities comes, we'll look into that also.
Very open statement. No, my question is IPO next financial year or next calendar year?
The idea is to come before the end of this financial year. We are getting ready for it.
Good luck. Thank you very much. And you've been very, patient with the questions. You've been very, open about sharing your thoughts and where the group is headed. It's such a pleasure to have you on ET now.
Thank you. Thank you very much for your time and inviting me and giving this opportunity. Thank you.
Let's take a break. Markets for the moment not going anywhere, but we still have a long day ahead. If banks, they pick up slightly, it could be a completely different kettle of fish. And now flashes are coming on G20. I think that's the US Treasury Secretary Janet Yellen believe G20 has been very effective. Slow down the flashes, please. Let me read them. Monitoring China's economic challenges do not see directly impacting US, but she's excited about G20. All of us are excited to host everybody in terms of the G20. The Global Power Center for next couple of days will shift to India, and that's where deal making, negotiation, and a lot of future talk would be held. Let's take a break. When we come back, some stock ideas from Kunal.